When it comes to retirement planning, there's a powerful tool that often flies under the radar, and that's the Health Savings Account, or HSA. And while these are primarily viewed as tools to use for short-term medical expenses, they can play a powerful role in long-term planning and setting you up for a successful retirement. In this video, I want to talk about how an HSA can help you for your long-term retirement planning, not only for medical expenses, but also potentially for tax-free income to use for anything you want in retirement. And we'll talk about a little-known loophole a little later in the video. First, let's talk about what is an HSA. So the Health Savings Account was developed to work in conjunction with a high-deductible healthcare plan. So your employer might offer a high-deductible plan or the option to participate in a high-deductible plan. And if you are participating in that, then you could also set up a health savings account to accumulate dollars to use for future deductibles or future out-of-pocket expenses. Now, the high-deductible healthcare plans, as they sound, have higher deductibles. And so for an individual, that's currently $1,500, and for a family, that's $3,000. And so with the higher deductibles, those plans offer lower monthly premiums, so they can fit a budget better. But with the higher deductibles, you also want to be sure that you've got some money set aside to meet those higher deductibles, and that's what the HSA account allows you to do. Now, the HSA account can be set up through your employer, and you can contribute directly from employee payroll deductions, or you could set it up outside of your employer and make contributions to that on a regular monthly basis or periodically to try to build those accounts up. HSA accounts offer some long-term investing options within them as well that could help, especially when we're talking about long-term retirement planning. Most HSAs require you to keep a minimum amount in a money market account, like maybe $1,000, but then you could be eligible to invest the balance in any number of long-term income solutions like mutual funds or exchange-traded funds. That varies by the HSA provider. Now, HSAs offer the most attractive tax benefits of any retirement or investing accounts. They're triple tax advantaged. They've got first the tax deduction for any contributions you make to the HSA. Number two, if you're investing those and they're growing, that is tax deferred growth within the HSA. And number three, if you pull money out for qualified medical expenses, that is tax-free as well. So you've got those three benefits going within the HSA plan. Additionally, the HSA plans do have contribution limits. And for an individual in 2024, that amount is $4,150. And for a family, that's $8,300. Now, both of those plans offer a catch-up. So if you're over age 55, you can contribute an extra $1,000, making it on an individual basis $5,150. And for a family, it could be up to $10,300. One little known fact with an HSA is in order for the family to get the additional $2,000 age 55 catch-up contribution, both spouses need to have an HSA account. Typically, one spouse will set up an HSA and contribute the maximum prior to that age 55 limit. Once you both reach age 55, in order to take advantage of that extra catch-up contribution, the second spouse should set up an HSA and at least put in the $1,000 into that account. Let's talk about how an HSA can really benefit your retirement planning. Fidelity Investments does a survey on an annual basis to quantify what the out-of-pocket expenses would be for a couple age 65 over their remaining lifetime for medical expenses. And again, these are out-of-pocket numbers. And currently, that number is about $350,000. So the HSA can go a long way to help you accumulate some investment dollars that you could use for any of these out-of-pocket expenses. And as I mentioned, one of the big benefits with the HSA is not only do you get the tax deduction going in, you get the tax-free growth as time goes on, but if you're going to pull money out for qualified medical expenses, it's going to be tax-free as well. And the IRS in publication 502 has a significant list of qualified medical expenses that can be for dental work, corrective eye surgery, prescription drugs, some Medicare premiums, improvements to your home that are necessary for medical, chiropractor, just a full list of things available that you could use those dollars and pull them out tax-free. And that's certainly an attractive way to go. Additionally, the HSAs allow you, once you're age 65, to pull money out for any reason. So it doesn't have to be any medical related reason. The only caveat is every dollar you pull out, you're going to pay tax on. So that puts it on par with a 401k or an IRA account. Still a great long-term retirement savings plan. The last thing, and most people miss this, that'll allow you to take money out tax-free and spend it on anything you want. The HSA allows you to reimburse yourself for prior expenses. So if you've set up an HSA and you've decided you're not going to take money out for current medical needs or deductibles within your plan, you can keep those receipts and document the out-of-pocket expenses for the qualified medical expenses that you've paid over the years. And you might, if you're prudent at record keeping, that could be $10,000 or $20,000 or significantly more than that. So then in retirement, you could decide, pull those receipts out, say, I'm going to pull out $10,000 out of my HSA account this year. I've got $10,000 in receipts of things I've paid out of pocket years ago. Now I don't have to pay any tax on that. I can use that money for my retirement living, for travel, for a major purchase. And so those HSAs give you great flexibility that can help you fund all of your retirement needs. For more financial content, please click the subscribe button below. I'm Tim Hawkins with Wealth Charter Retirement, simplifying wealth, one video at a time.